Right, hello everybody, and welcome to the episode on my channel. So if you've been paying attention to the stock market and REIT stock prices in particular, you would have noticed one thing. Their stock prices have been declining significantly. Now, Realty Income is no exception. Realty Income stock price has basically fallen off a cliff. So what I wanted to do today was provide a brief business overview, look at some of the financial metrics for Realty Income, do a REIT valuation on the stock price of Realty Income, then discuss some pros and cons of holding the company, and discuss what I'm actually doing with my Realty Income position. Am I buying some more Realty Income? Am I selling it? Or am I waiting on the sidelines? So if that's some content that you're interested in watching, I encourage you to give this video a thumbs up and subscribe to the channel. And without further ado, let's go and dive right in. So Realty Income has coined themselves as the monthly dividend company. They are a dividend payer that pays a monthly dividend to their shareholders. Therefore, it is beloved by income or dividend investors. Now, they are a S&P 500 company, and they have 13,100 properties across 85 separate industries, leased to over 1,300 clients throughout all 50 of the states, as well as some international exposure in Puerto Rico, UK, Spain, Italy, and Ireland. Now, what they do is they generate cash flows from this real estate portfolio and increase those monthly dividends in line with their funds from operation as they continue to increase their rents from those properties. So we scroll down, we can see the pillars of Realty Income. They focus on high quality real estate, have a conservative capital structure, prudent growth strategy, and then corporate responsibility. Now, this high quality real estate that they talk about, they like to focus on acquiring freestanding single unit commercial properties leased to what they consider to be high quality clients or tenants under long-term lease agreements, which are usually in excess of 10 years. So what's the beauty about Realty Income's business is it is a triple net lease business. So they lease on what's called triple net leases. And what is a triple net lease, you may ask? So if we go and look up triple net leases, they are a lease agreement on a property whereby the tenant or lessee promises to pay all the expenses of the property, including real estate, taxes, building, insurance, and maintenance. So again, it is a beautiful, beautiful thing in terms of a commercial rental agreement because the tenant themselves is responsible for paying the real estate taxes, building insurance, maintenance, all of that in utilities in addition to the rent. Now again, these triple net leases are usually found in commercial real estate, but one thing to note here is these triple net leases do tend to have lower rents because the tenant assumes those ongoing expenses such as these noted up here, which would have otherwise been the responsibility of the property owner or Realty Income in this case. But again, a very simple model. These triple net leases pass down the burden of paying these additional costs of the building to the renter or leasee, I guess you could say. Now let's go and look at the investor presentation of Realty Income. So we can see they have a proven track record of returns, a 14.2% compound annual total return. So again, total return being the dividend and share price appreciation since listing or going public in 1994 on the New York Stock Exchange. They have a beta of 0.5. So again, very, very low when compared to the beta of the total stock market. Stability and growth of earnings. So 26 of 27 years of positive earnings per share growth. That is music to my ears. I love to see consistent and positive earnings per share growth in the companies that I have invested into. 5% median adjusted funds from operation per share growth since 1996. Consistently increasing dividends. Now, if you all know me, you know I am a dividend growth investor, so consistent and increasing dividends is music to my ears. 4.4% compound annual dividend growth rate since 1994. So again, it's not huge dividend growth, but consistently increasing at 4.4% since 1994. I still think that's a great record for them to hold. Now they are in the S&P 500 Dividend Aristocrats, positioned for continued growth. They have $12 trillion of estimated global net lease addressable market. They're talking about the total net lease market, and then 95 billion of sourced acquisition opportunities in 2022 that they were able to take advantage of. All right, so we can see Realty Income is the global leader in a fragmented net lease sector. So let's look at their international presence. Now, they're the fourth largest global REIT. They have a $7.6 billion European portfolio, 303 assets, average 9 years remaining lease term. Like we saw before, they have around a 10-year lease term, and they operate in 38 industries. As you can see, they do have some European exposure, but their main concentration is in the United States and also here in Alaska, the upper part of the United States. Now, size, scale, and quality, $62 billion enterprise value, $3.8 billion of annualized base rent, and a high credit rating from both Moody's and the S&P at an A3 or A- grade rating. 54 plus years of operating history, like we saw before, 13,100-ish commercial real estate properties, and their tenants here, 40% of the rent received from their tenants is from what they call investment grade clients. So again, these investment grade clients receive a rating from ratings agencies such as Moody's and S&P, and they are given a high grade or rated as a investment grade client. And again, that just speaks to the level of credit risk or credit worthiness of the client and how an external credit agency believes that the client of Realty Income will be able to pay their rent. Now, diversified real estate portfolio, 91% of the total rent is resilient to the economic downturns and isolated from e-commerce pressures. So again, very key fact here. And again, looking at this, 15% is non-retail, 76% is non-discretionary, low price point, and service-oriented retail. So focusing on those low price point retailers or service retailers here. Now, 1,300 clients across 85 industries like we saw, and in all 50 states, and also international exposure in Ireland, Italy, Spain, and the UK. Strong dividend track record. So, like I said, we like getting dividends. As investors, we want to get paid for our investment, and Realty Income paying a monthly dividend is great. So they've had 637 of those monthly dividends declared, 103 consecutive quarterly increases, and as we can see, that represents a 4.4% compound annual growth rate of that dividend from 1994, starting at 90 cents per share, all the way up to $3 and roughly 6 cents or 7 cents per share here. Again, just great growth, steady growth over time. All right, so let's look at their real estate portfolio. So here are their tenants. So we can see that they have a diversified high quality portfolio, and their top 20 clients are listed here. Now, Dollar General, we have Walgreens, Dollar Tree, 7-Eleven, we have EG Group, we have The Wynn, FedEx, BQ, Sainsbury's, LA Fitness, BJ's, Lifetime Fitness, CVS Pharmacy, Walmart, Sam's Club, Tractor Supply Co., Tesco, AMC, Red Lobster, Regal, and Lowe's. Now, what I love about this chart is that it's not too highly concentrated in one specific tenant. So these top 20 tenants, again, very spread out here in terms of percentage of actual contractualized rent. So now they've been in the news, Dollar General and Walgreens and even CVS specifically having some financial trouble as well. So again, that could be one of the causes to why Realty Income's stock price has fallen, because people see trouble with their tenants. They might not be able to pay the rent, or they might go out of business. In my opinion, this could be a future effect on Realty Income. In the short term, I don't really see it being a detractor or a significant detractor. And again, when they represent 3% or 4% of the actual total rent, that's not a huge portion of the rent in my opinion, and Realty Income could definitely repurpose or re-rent these properties out if some of the tenants here went out of business. But again, in terms of the entire tenants going out of business, I highly doubt that would happen. It would probably be certain chains or certain stores that would shut down, not the entire Realty Income base for that specific tenant. Now, the diversification of the industries that Realty Income rents out to, 11% in convenience stores, 10% in grocery stores, 7% dollar stores, almost 6% in home improvement, almost 6% in drugstores, restaurants. We have casual dining, health and fitness, automotive and service, general merchandise. So again, in the top 3 or top 4, I guess you'd even say top 5 industries that they rent out to, or their tenants, these are essential industries and tenants. So again, I believe that they will be there for the long term, paying that rent and increasing realty incomes, fund from operations, or rent revenue over a long period of time. Again, here you can look at the property type diversification. You can see they have 82.5% in retail, 13% in industrial. They just started into the gaming, 2.7% and 1.7% in other, and they are diversified across the different states here as well. So the top 20 clients, here's looking at them in a Venn diagram. So again, this is just speaking to whether they're service oriented, non-discretionary, low price point, and the ones that cross over into each of those. And again, feel free to pause or take a screenshot if you like, if you want to look at that. Now we're going to look at realty income on Seeking Alpha, and we'll look at some financial metrics. So as you can see here, over the past month, it's down about 8.8%. Over the past 6 months, it's down about 18.8%. And year to date is down about 21.19%. So realty income has been on a huge dip, and this has people wondering whether the dip is warranted or whether it's just an overreaction. So as we can see, it's trading around that $50 range right now, and the 52-week low has been about a 48.42 price, and the 52-week high was a 68.85 stock price. So a lot of the discrepancy there, or a huge range there, I guess. Now, when we look at realty income's specific metrics, we can see that the dividend on a forward basis is $3.07, and this represents a whopping yield of 6.03%. And that is the dividend yield. So whopping dividend here they are paying out in terms of yield. Now, let's go and look at that dividend specifically. So the dividend safety here has been rated a B- grading, dividend growth a B+, dividend yield B-, and the consistency as a A+. Now, when we look at the dividend summary, we can see that yield is 6.03%, represents $3.07 like we saw as an annual payout. This is a 74.14% payout ratio, and the 5-year dividend growth rate is at a 3.70%. Now, they've had dividend growth for 25 years. So let's go and dig into these dividends a little deeper. So if we look at the dividend growth rates, we can see that the 3-year dividend growth rate is actually at a 4.08% compound annual growth rate. The 5-year dividend growth rate is at a 3.70% compound annual growth rate, and the 10-year dividend is at a 4.15% compound annual growth rate. So as you can see here, the average kind of falling in between that 4-ish% compound annual growth rate of the dividend, or that 4.4% as they stated previously in their investor presentation. So decent dividend growth, nothing to write home about, but again, keeping up or slightly ahead of inflation in my opinion. Now let's look at the dividend safety, because when we're investing, we want to invest into companies that can sustainably and consistently pay the dividend without the fear of us having to have a company that would cut that dividend. So the cash dividend payout ratio is 70%. And when you're looking at REITs, you want to look at the adjusted funds from operation payout ratio, or the AFFO payout ratio. Again here, 76%. In my opinion, that is a healthy and sustainable dividend payout ratio. They're not paying out 90% of their earnings. It's in the mid to lower 70s. So again, a decent payout ratio here in my opinion. Now let's go and look at the financials. All right, so what we want to see here is rental revenue and total revenue increasing over time. So as we can see, total revenues have increased from 2013 up until 2022 or 2023. That has been in a steady line. Now, what else do we want to look at when we're looking at REITs? We want to look at their basically their FFO and their funds from operations, and that has been increasing steadily. Now, one thing to note about REITs is they do take on a lot of debt and issue a lot of shares in order to acquire their properties. So their funds from operation, or their operational metrics per their share basis will be a little skewed. So that is just something to consider because their main focus is generating cash and distributing that out to their investors, not specifically buying back shares or not trying to reduce the debt. But we do like to see a balance of both in REITs. So the funds from operations per share, those have been steadily increasing, again at a slower rate because REITs do issue shares. And when we look at the adjusted funds from operations, we can see that is slowly increasing as well. All right, so let's go and look at the REIT valuation. So what I've done here is, again, shout out to my friend Dividendology. I'm using his REIT valuation model. If you haven't checked out his channel, I'm going to leave a link in the description below and in a comment. It is a great valuation model. And if you haven't checked out his channel, again, I'll leave a link in the description below, so feel free to check it out. So using his dividend discount model or his REIT valuation spreadsheet, we're going to be looking at two valuation metrics. First, we're going to be looking at the AFFO multiple valuations and then using a dividend discount model. So the whole point of this is to try to gauge or see what we believe Realty Income stock price could be valued at and determine whether we think it is a decent valuation in terms of a fair price or is it undervalued. Now, it could also be overvalued, so we want to go through this analysis. So what I've done here is looked at comparable REITs in my portfolio. So when I look at my holdings, I hold Vici Properties and I hold Agri Realty. Now, in my opinion, Agri Realty is probably a little bit more comparable, but we'll go through the valuation nonetheless. So as you can see here, I added the FFO multiples here, and for each of these, the average FFO multiple being around 13.78. And when we compare that to Realty Income's FFO or price per FFO, we can see that it trades at a 12.58. So this is a discount to the average here of the multiples of my other REITs. So that could suggest that Realty Income is actually slightly undervalued. Now, when we calculate this, the intrinsic value of Realty Income comes out to be about $55, and the current trading price of Realty Income is 50.28. Let's go and look at the dividend discount model. When we look at the dividend discount model, I included the dividend payout here for each of the past 4 years, the yearly dividends, and the annual growth rates here. So the average growth rate here was 4.31% in terms of their dividend. Now, I don't expect them to continually to grow that dividend by 4%, being a little conservative and saying that they will grow that dividend by maybe 3% for the foreseeable future. Now what I've done is put a discount rate here or a weighted average cost of capital at about 8%, and that gives me a DDM or dividend discount model price per share of 64.27. The current price here being $50.30 as we saw before. This could mean that Realty Income might be, significantly undervalued at about 27%. So when we look at the total valuations here, we just looked at the AFFO multiples valuation at 55, the dividend discount model valuation at 64. Average them together gives us an intrinsic value of around $59.67. So the current trading price of $50.28, and then we have a margin of safety. So if you want a 10% margin of safety, you could be possibly buying this company right now. If you're a little bit more conservative and you're looking at a 15% margin of safety, it still would be a buy. Now, in my opinion, if you're super conservative and you wanted a 20% margin of safety, you could wait to 47.74 or 47.74 for the stock price to buy. In my opinion, I believe that 15% here as the margin of safety for such a quality company here is reasonable. So let's conclude and look at the pros and cons. So the pros and cons of Realty Income here, and we'll go back to the website here, but Realty Income, again, is a solid company, has a solid track record of paying dividends, and they've paid monthly dividends consistently. They have, in my opinion, are trading at a fair valuation like we just saw in the REIT valuation model. And again, shout out to Dividendology. Thank you for letting me use that REIT model here in my video. Now, the cons. Realty Income is a mature company. It's big. So just according to the law of law numbers, as you get bigger or big enough, it is hard to find other avenues for growth. Now, this can also lead us to conclude that they may have a lower growth rate moving forward in terms of their funds from operations, and that may result in a lower dividend growth. Now, in my opinion, I projected a lower dividend growth rate as well. So what am I doing? So I actually have been buying Agri Realty, and I'll leave a link for you to that video in this video. Feel free to check that out if you haven't. I've been buying Agri Realty and VG properties, but I've also started to add Realty income. Now, I did sell Realty income around the $59, basically at break even, just because the valuation, in my opinion, it wasn't really undervalued. It was more at fair value. But now I see an opportunity to grab hold of Realty income because of that higher dividend yield at 6%, forecasting, a 4% AFFO growth. So again, that in my opinion can lead to 10% annual return there. And then if we have any multiple expansion on their stock price, that can lead to more mid-digit or mid-double-digit growth, in my opinion. So I'm going to be continue adding Realty income. Started a starter position, and hopefully I'll be working that up to a 2.5% or 5% position in the future. But again, that's all based on whether the valuation stays at this price and whether I can continue to buy or not at this price. So I hope you enjoyed the video. If you did, please leave some comments below. I encourage you to continue to watch the channel. And with that, I'll see you in the next one. Thanks. Bye. Please note, I am not a financial advisor by any means. Please do your own due diligence when investing, as investing is inherently risky and you can lose money. Please note, I am not liable for any investing losses you incur or any investing decisions you make. Thank you very much. Have a great day.